Thank you for introducing me and for inviting me to the conference. So this is joint work with Roman, who's also at Warwick Business School. So DAI is a stable coin that is typically backed by cryptocurrency collateral and is managed through smart contracts. So it's a decentralized stable coin, and it's governed by the Maker DAO protocol. And to generate DAI uses leverage collateral assets, typically Ethereum, and can borrow a fraction of the collateral as DAI tokens. And the focus of this paper is thinking about the sources of peg instability. So we start off by thinking about some empirical facts. So the peg deviations have ranged from -4 to +8%. The DAI tends to trade at a premium when ETH returns are negative. So there is this negative co-movement between DAI prices and ETH returns. And ETH collateral is more risky. So in other words, when ETH collateral is more risky, DAI prices are more volatile. So there's this link with collateral risk. And the last empirical fact is that the peg has become much more stable since the introduction of stable collateral. So we will think both through a model and empirical evidence about the link between riskiness of the ETH collateral and the DAI peg. We will motivate our model with the sort of liquidations of DAI during a period when ETH collateral crashed. So one such period was the so-called Black Thursday crash in 2020 when ETH prices dropped by 50%. And lastly is the safe haven effect of stablecoins as a potential alternative. So the DAI peg and collateral risk, there's an intimate link between the volatility of DAI and the volatility of ETH collateral. And the way to think about it is that when the collateral is risky, it acts as a limit to arbitrage for investors that seek to stabilize the price of DAI. So if you are an arbitrageur, you want to effectively eliminate peg deviations by shorting DAI when DAI trades at a premium. But the problem with shorting DAI is that you need to deposit ETH collateral, and that's risky. So it's, in other words, it's a limit to arbitrage because of valuation effects of the collateral. And so if you are going to short DAI, you need a significant premium to compensate for that collateral risk. So if you have a stable collateral type, then that means you can now short DAI using a stable collateral. And so that's closer to a risk-free arbitrage. And through that, you can increase peg efficiency. So the negative co-movement of DAI and ETH returns is most sort of obvious when we think about the liquidation events. So March 12, 2020 is a nice case study because during this day, ETH crashed by about 50%. And at the same time, there was big liquidations of DAI. So I'll explain shortly why DAI needs to be liquidated when ETH returns collapse. But these DAI liquidations essentially result in significant DAI premiums, and which reached a peak of, say, 800 basis points on March 12th. So in this talk, we'll first introduce how DAI is created and discuss some of the governance parameters. In the model, we'll go through the timing, the comparative static results. So we want to kind of show our extension of stable collateral as improving the DAI peg. And for empirical evidence, we have three types. We have CDP level data where we actually have individual investor positions on DAI borrowings, ETH collateral, and so on. We have data on peg price deviation, so we can investigate sort of the fundamentals of the negative co-movement between DAI prices and ETH returns. And then third, we investigate the effect of introducing stable collateral types. Okay, so as I mentioned, DAI is typically backed by cryptocurrency collateral, and users deposit a certain amount of collateral in a vault, typically Ethereum, and can borrow a fraction as DAI tokens. And the amount that they can borrow is governed by this leverage ratio, so there's essentially a maximum amount that you can borrow that's governed by the protocol. Users can use DAI to buy it in exchanges. So you can also use it for secondary market trading. And of course, previous speakers looked at DAI in the context of, say, Uniswap and decentralized exchanges, for example. And there are many other potential applications for using DAI as well. So when you deposit Ethereum in a collateral in a vault, you borrow a fraction as DAI tokens. So the protocol essentially constrains the amount you can borrow. And this is the maximum leverage for a vault. And for Ethereum collateral, you can borrow at most up to 2/3. So the motivation behind these leverage constraints is to make sure that the vault is over collateralized, right? And of course, if Ethereum prices crash, then you can trigger a liquidation event. And a liquidation event is when an investor has to repay the debt. So all of the debt up to the value of their DAI tokens have to be sold. And those DAI tokens have to essentially be burned out of circulation. In general, liquidation is costly, so the protocol charges a penalty rate of up to 15% when an investor has to liquidate their position. So in general, as I'll show graphically, investors over collateralize. So the stability tools, the protocol has a stability fee on DAI borrowings, which is analogous to a central bank rate. And through changes in the stability fee, they can tune the supply of DAI. How they are managed is through a decentralized vote, where users stake the governance token in order to vote on these policy parameters. The safe collateral types, there are two events. In March 2020, the MakerDAO protocol decided to adopt the USDC as a collateral type. And in December 2020, the peg stability module was introduced. And this is similar to the concept of stable collateral. Now, the governance enables a direct swap of USDC for DAI. So through these smart contracts, a user can now swap one USDC for one DAI with the protocol. And this essentially means that the user does not need to create a vault and deposit collateral. They can now just borrow DAI through a swap of USDC for DAI. So some of the descriptives, we have the DAI price which, as I mentioned, can fluctuate from discounts of about 400 basis points to premiums of 800 basis points. The ETH price, as we know, is risky. So that's the source of collateral risk. The leverage ratio for ETH collateral is 2/3 or 66%. And the leverage ratio in practice is much lower. And that's this idea that you over collateralize because of the risk of liquidations. And these are some of, and the last panel, we have some interest rates, the stability rate set on DAI borrowings, and then the savings rate is also set by the governance. Okay, so to start off, we have a model to explain the fundamentals of DAI instability. The model is 3 periods, where period 0 and 3 are the opening and closing of the CDP positions. Investors borrow DAI in period 1, and arbitrageurs long DAI. So investors are the ones that are depositing ETH collateral and borrowing DAI and selling it in the secondary market. Arbitrageurs take the long position in period 1. Period 2 is where we have the DAI demand shock, and that's the period of interest in our model. And that's when arbitrageurs, they have to essentially clear the market, and in some cases require a large DAI premium in order to do so. So these are the agents. So as I mentioned, the ETH speculators are the ones that deposit ETH as collateral and then borrow DAI tokens. We assume extrapolative beliefs where ETH speculators are borrowing DAI based on their expectations of ETH returns. So ETH returns has a good state or a bad state. Arbitrageurs are stepping in to profit from deviations of the DAI price from Unity. So they have the option of taking a long position if DAI is trading at a discount, or they will short DAI if DAI trades at a premium. And then we have an exogenous public demand in period 2. So these are the evolution of wealth for our agents. So for ETH speculators, their wealth evolves based on the leveraging of their ETH returns. Arbitrageurs have either a long position or a short position. So the first line of the arbitrageur wealth evolution is if they take a long position in the DAI market, and the second line corresponds to when they take a short position. So when they take a short position, they are also depositing ETH collateral and borrowing a fraction as DAI tokens. And our agents have mean variance utility. So the market clearing conditions are in periods 1 and 2. So they are the periods when there's the secondary market trading. So in period 1, we have the supply of DAI by speculators, and arbitrageurs take the long position. Then period 2 is when we have some exogenous demand, and arbitrageurs can take either a long or short position, depending on whether they need to clear the market, whether the market's in excess demand or excess supply. So we calibrate the model for 2 types of volatility. So in panel A, we have the low volatility, and panel B, we have high volatility of ETH collateral. Now, in low volatility, it's good for ETH speculators, right? So in the case when ETH speculators are happy to supply DAI in the market, then it turns out that you can actually be trading at a discount. in this case. Where things get interesting is if ETH volatility is very high, then we find we can generate DAI premiums if the ETH returns are negative. So in the bad state of the world, ETH returns are negative. And so that means the speculators don't want to leverage ETH. So they're essentially deleveraging and supplying less DAI in the market. And so arbitrageurs have to fill in the gap. They have to supply DAI in period 2. And the only way they can supply DAI is if there's a significant enough premium for them to earn profits. So arbitrageurs are basically commanding a premium in period 2 to supply DAI in the market. So that's the premium we observe for high volatility, bad state in panel B. So in terms of what's happening, if we look at our equation in period 2, so we have some demand for DAI, and in the bad state of the world, the supply of DAI by speculators shrinks. So now to absorb the demand, all the supply has to come from arbitrageurs, and that's what's generating these premiums that we see in the model. Okay, so in addition, we can look at some comparative statics. So here we have comparative statics with respect to the volatility of ETH. So when ETH volatility is high, then DAI volatility is high, and that's our collateral risk observation, that the DAI peg is more unstable when ETH volatility is high. And in the first panel, panel A, when ETH volatility is high, we get high premiums in the bad state. And the mechanism is coming from this fact that we have this deleveraging by ETH speculators when ETH volatility is high. We can also look at the stability rate. So the stability rate does have some effects of changing leverage and changing DAI prices in the model. And in the model extension, we look at adding a stable collateral. So now arbitrageurs can use the stable collateral to short DAI in the market. And as a result, we find that DAI volatility is reduced when you use stable collateral. And the share of stable collateral used also increases when the stable collateral has a low volatility. So that's quite intuitive that in periods when the stable collateral is relatively less volatile, you would increase the share of stable collateral. Okay, so our first empirical evidence is looking at individual CDP positions. So we have this data for the period when the only collateral type was Ethereum. And we have up to 456 CDPs with at least 30 observations in this sample. And the idea is to look at the effects of returns, volatility of ETH on DAI borrowings and ETH collateral for individual CDPs. So our results are that in response to an increase in ETH returns, individual CDPs are borrowing more DAI, which we would expect. They're also depositing more ETH collateral. The net effect is to reduce their leverage, and that's because the leverage ratios is capturing the ratio of DAI borrowing to ETH collateral. So in both cases, these speculators are increasing their ETH collateral and also increasing their DAI borrowings, but the ratio is going down. So that's just a case of both the numerator and denominator going up. We find that the volatility of ETH ends up having a significant negative effect on the leverage ratio. And we also find some effects of the stability fee is reducing DAI borrowings. So we then look at fundamentals of peg deviations. And again, we are interested in ETH returns effect on DAI prices. And so delta is our deviation from the peg. And as we would expect, there's a negative co-movement between DAI prices and ETH returns. And so this goes back to our finding that in bad states of the world, so when ETH returns are negative, we see DAI premiums. So that's what we find empirically. The volatility of DAI is strongly correlated with the volatility of ETH, and that's the collateral risk observation. So in terms of channels to explain this premiums, one important factor is the amount of liquidations. So in periods when a lot of DAI is liquidated, they are precisely the periods of negative ETH returns. So we find a strong relationship between our liquidation and DAI premiums as we would expect. And in the context of our model, liquidations are very much like a deleveraging by speculators, right? Because the liquidation forces speculators to sell their DAI tokens, or essentially burn their DAI tokens. And so that liquidation forces DAI premiums through the lens of our model. And we also find that liquidations are, once you account for liquidations, the effect of ETH volatility on the DAI premium shrinks. So it becomes less significant. So that suggests that a lot of the effects we find are based on these fundamentals of the deleveraging in response to ETH returns, as opposed to alternative sources of premiums like safe havens, for example. So the last evidence is thinking about safe collateral types. So here we have a couple of policies. As I mentioned, USDC was introduced in March 2020. And in December of last year, they introduced the peg stability module. And the peg stability module allowed this 1-for-1 swap of DAI for USDC. And so this makes arbitrage very easy because now users, they can directly swap USDC for one DAI if DAI trades at a premium and sell it in the secondary market. And we note that the DAI USDC price basically converges following that event. So it was very successful as a stabilizing mechanism. And in terms of breakdown of DAI, we note that for most of its history, it was ETH collateral, but since the PSM, there's been a lot more DAI borrowed either through the PSM or from USDC as a collateral type. So as a final test, we do a diff and diff where we compare DAI USD prices to USDC USD prices, USDC being another stable coin. And we find that there is a convergence of peg prices following the PSM, and it's quite a large convergence. So we find a diff and diff coefficient of about 100 basis points convergence of DAI USD to USDC USD prices, and also a relative decline in volatility of the peg as well. Okay, so we investigated the importance of collateral risk. We showed this negative co-movement between the DAI, PEG, and ETH returns. And we showed that if we introduce a stable collateral type, that reduces the limits to arbitrage. And now it gives arbitrageurs sort of the ability to stabilize the DAI PEG. And we find empirically this negative correlation between DAI prices and ETH returns. And the collateral risk is a fundamental driving instability of the PEG. And that US following the PSM, the PEG became much more stable. Just some final thoughts. So clearly the bottom line is that we need a stable collateral for a stable PEG. In terms of design of stable coins, of course, we know the competitors are dollar-backed stable coins like Tether. And here there's an interesting point about custodial risk, right? So I think the elephant in the room is that, okay, so DAI has become much more stable, but the reality is there's much more custodial risk in the sense that the governance protocol now holds a lot of USDC in their reserves. And so to the extent that USDC collapses, that could be sort of a risk to the governance of the protocol. And I think in the future, one could argue whether a digital dollar could replace USDC as a dominant collateral. So there's also about digital dollarization and of the blockchain, whether that would also change the future of DAI. And thank you.